Good afternoon, everyone, and thanks for being with us today, the fourth day of our 2021 edition of the LuxFLAG Sustainable Investment Week. But before we start, we at LuxFLAG would like to take a moment to thank you all for your support during this last very difficult month since the very tragic passing of LuxFLAG's general manager, Sachin and Callas. Sachin was a great human being and certainly a tireless supporter of sustainable finance. He exemplified LuxFLAG with his passion, ambition, and drive to move to a sustainable future. Thank you. In my role as acting general manager of LuxFLAG, I'm very pleased to see that only after 2 editions, the LuxFLAG Sustainable Investment Week has already gained a lot of recognition. And that is thanks to LuxFLAG's associate members who are showcasing this week where they are in the sustainable finance journey. Given the finance industry is on different stages of that journey, this week is about sharing best practices so we all advance towards the goal of making all finance sustainable. For the 3rd edition of LSIW, we thank you for such a positive response with over 3,500 registrations. This is amazing, and I'd like to thank you all, our host partners, as well as our media partners. The 25 sessions over the week cover the latest trends and most pressing issues in sustainable finance. We hope you find them useful and also find some inspiration in the progress being made to harness finance to help find solutions to our current environmental as well as our social challenges at hand. A few words on the housekeeping. The slides and the recording of the sessions will be made available to you sometime after the LSIW. For Q&A, please use the Q&A function at the bottom right of your screen. In case we don't get to have the time for questions at the end of the session, the questions will be forwarded to the host for subsequent responses directly to you. But now, let's turn directly to the session. I'm very pleased to welcome not only you all, but especially our speakers to the 4th session of today, which is hosted by GSK Stockmann. For more than 20 years since its foundation as an association of lawyers, GSK Stockmann operates as a law firm of choice for real estate law and financial services, while also delivering deep-rooted advisory services and expertise for funds, capital markets, international investors, and many more. So I'm really excited to listen to GSK Stockmann and the panel for their insights and expertise on the topic of today, being ESG challenges for your investment process. For that, I'm pleased to introduce the excellent speakers who are with us today. First, we have Irina Stolyarova. So Irina is a senior associate at GSK Stockmann here in Luxembourg and will actually also take the role of the moderator of the panel. She's joined by Flavia Michilotta, Director ESG Solutions, Fund Services and Global Solutions at TMF Group. She's also joined by Aurélien Rühlens, Investment Director and ESG Coordinator, Cube Infrastructure Managers, as well as by Justus Wiedemann, Quantify. He's the founder and CEO there. With that being said, to all of you again, thanks for being with us today and enlightening us. Irina, the floor is yours. Thank you.
Thank you, Michel. Good afternoon, everyone, and thank you, Michel, again for your kind introduction. So I'm delighted to welcome you here today, and I'm happy to moderate our today's session, focusing on ESG challenges for your investment process. I'm pretty sure the topic might be familiar to each of you, given we all encountered some challenges, in particular this last year due to entry into the force of Level 1 of the Sustainable Finance Disclosure Regulation and upcoming taxonomy. As a lawyer, I must admit that SFDR, or Sustainable Finance Disclosure Regulation, created lots of issues and challenges around its interpretation and implementation. But we're not going to talk today about legal points, but rather focusing on the practical side of the ESG topic. In our today's session, we are going to focus mainly on understanding of ESG at boards level and integration of ESG factors across investment lifecycle, decision-making process from the fund manager's perspective and the diligence process, and also solutions for ESG environment within the real estate industry. I would like to start from you, Flavia, as a representative of the administrator, an expert in the ESG area. Could you please tell us whether you see any challenges in terms of corporate governance and understanding of ESG challenges and opportunities at the boards of various companies? Do you see any particular advantages also of full integration of ESG factors across the investment lifecycle?
Thank you very much, Irina, and thank you very much, LuxFLAG, for having me today. And thank you very much for the question, of course, which indeed, sees me setting a little bit the stage when it comes to defining the growing momentum around sustainable finance and responsible investing, which has definitely helped shape the determination, particularly in the last few years, and even within the private business, that integrating ESG considerations into all aspects of the private equity process, including target sourcing, due diligence, and deal negotiation, board oversight, and route to exit, has indeed grown exponentially in that respect. Firms can now generate value all along the investment chain, and they understand that increasingly. Integrating ESG allows firms to track and manage financial sustainability and meet compliance needs in line with increased regulatory ask. For companies and their boards, this is key, and all boils down to good corporate governance, as you were mentioning, the famous G criteria that is so still often overlooked when talking about ESG. A strong sense of corporate governance means also that board of directors are more attentive with defined responsibilities and in general more able to maintain control over their business. It usually also translates into better risk management and reduced opportunities for fraud or corruption. Corporate governance has become more important than ever within the private equity space for both institutional investors and fund managers. When private equity firms invest in a company, there are a number of questions that need to be addressed in the interest of creating value for investors around the decision-making process and how that needs to be managed across shareholders, the board of directors, and management. Building strong governance, creating and fostering deep expertise in boards within portfolio companies is crucial to returning value to investors. We all agree that the tone needs to come from the top. And as you were mentioning, Irina, indeed, the role of boards and how they managed is indeed a crucial point here. And if boards intend to be successful in this exercise, they should be open to consider structured ways to define the essentials of measurement and performance in relation to ESG, and accept also to be challenged on ESG considerations in this respect. In line with this reasoning, appointing the right independent directors is part of those key considerations that need to take place. The right directors help assess the portfolio company's value creation possibilities, as well as the landscape within the industry. Companies are becoming increasingly aware of how strategic these roles can be as a source of guidance and growth. Ultimately, the right skill set can improve the management of the company. The GPs we are working with are increasingly confronted with a number of important challenges, and some of those are, of course, today revolving around ESG. For instance, they're discussing with us, how do I manage to structure an ESG approach for my investment? How do I assess and integrate carbon risk exposure? How do I ensure compliance with sustainable finance regulation? Or how can I track the ESG performance of the companies in my portfolio? Or even how can I gather the right metrics and translate those into meaningful reporting for investors? In our conversation with clients, we help them implement an ESG risk oversight framework to support and guide GPs understand the best course of action when confronted with some of those ESG-related queries throughout the investment process phases, and which per se hold the potential to add extra values to the investment choice. So for instance, during the pre-investment phase, we work alongside our clients to help them determine the investment scope, accompany them to make the best selections of companies through benchmarking and adoption of the most suitable investment strategies and the ones they will be able to sustain in the future with the best possible outcomes. This can guide them towards developing an holistic approach to managing ESG risks, managing and prioritizing issues on portfolio companies for future engagement activities. The onboarding phase is certainly the most impactful, but also the one that offers the most onerous tasks on the engagement side and development of an ESG framework. This is the chance for the managers, GPs, to set up responsible investment objectives and roll out different tasks across the team. It is where client needs to ensure they have an appropriate policies in place and support them in defining the processes and design the governance structure required to ensure a successful implementation and accountability system. Here, clients also need to assess the strategic interdependencies related to ESG criteria and how those are linked to reporting requirements. From here, GPs can select the tools to improve their performance in that respect by taking a series of steps like setting an environmental strategy, conducting a materiality exercise, filing for certification or a label. On the regulatory side in particular, reporting requirements are multiplying, as you were mentioning before, and becoming more precise in their ask. Today, reporting is truly a strategic and operational tool therefore moving away from the tick-the-box mentality of the recent past. And the European Commission worked towards fleshing out of a green taxonomy which defines sustainable categories of investment and which is linked to another central piece of legislation, the Sustainable Finance Disclosure Directive, SFDR, and its reporting, are going to become part and parcel of the way companies need to conceive their sustainability reporting going forward. The European Commission is also in the process of elaborating new reporting standards for companies reporting under the CSRD, which are going to enter into force a year from now. The three legislations I've alluded to are all intertwined to ensure companies reporting is aligned and material. For instance, just thinking about Article 8 of Taxonomy Regulation, companies are required to report on the extent to which their activities are sustainable or are thought to be sustainable. The reporting standards to be developed under the CSRD will take into account those indicators and below the sustainable contribution and do not significant harm criteria of the taxonomy. Reporting as the final phase of the investment cycle offers the possibility to demonstrate how the company has fulfilled its role and mission on many different perspectives. When it comes to ESG, it is good to demonstrate also what kind of level of impact was achieved. In this respect, helping companies understand the most appropriate reporting tools to serve investors' needs is not only part of good management, but is also part of the overall strategy of the board and the company. I give you back the floor now.
Thank you very much, Flavia. I fully agree actually with you. It's really important to raise awareness at various levels and specifically at the board's level, regardless of the fact whether it's a private company or private equity firm or fully fledged regulated fund or asset manager. Everyone needs to start looking at ESG rather as an opportunity and not as a risk. And yeah, the sooner the better. Thank you very much. And Justus, I would like to ask you another question. As a founder of Quantify, I understand that you developed a platform which is based on artificial intelligence that could help fund managers optimize and mitigate sustainability-related risk in the real estate industry, and even potentially provide analysis on how to make the real estate asset more ESG compliant or sustainable compliant. Could you please explain us how does it work actually in practice? What kind of solutions exactly can you provide to the real estate managers?
Absolutely. First of all, I want to thank you, Irina. Thank you to GSK, and also, of course, thank you to LuxFLAG for having me today. It's a pleasure. And yeah, I thought Flavia just made a number of very, very interesting and important points. I was just tagging along, trying to keep pace. And I think a couple of points stood out for me, especially when it comes to coming out of the real estate industry and actually trying to make these assets more sustainable. You know, before you start or structure a financial product, all of the assets have to be sort of looked at and have to be brought to a level of I guess, positive impact and also to a level of sustainability. So how can we get there? We have a renovation quota of around 1.2% across Europe when it comes to standing assets. And we also know that your asset management, real estate is currently responsible for over 30% of CO2 emissions. So this is why I have started my own business. Quantify is the first intuitive real estate asset management software for ESG optimization. And what we do is we gather all of the buildings into our platform based on over 200 attributes on each building, meaning we collect information on the building structure, all of the technical infrastructure of the building. We also cover some very, I guess, you would think of them as soft topics, but also very important tenant engagement data. So tenant satisfaction scores. Those are very important topics to look at, especially when it comes to large structures that require the owner or the asset manager to have tenants that are more interactive and are sort of reaching out when it comes to, for example, providing their utility data, which they're, of course, not obligated to inherently, but of course, that would bring more transparency into the building. So by gathering over 200 attributes on each asset, we create a structured data set. And based on the structured data set, we are then able to derive certain rules and basic functions where we say if there are no, for example, LED lights installed yet in the general space, and we have a certain, I guess, utility level which is above a certain threshold of its peer group, we might want to, our users, our asset managers, our users, to think of a potential LED refurbishment at the site. Or if there is no sufficient utility data available, we might want to think of enhancing the technical infrastructure within the building, meaning smart meters, for example. So basically, think of our tool as a facilitator of ESG improvements within an asset class, which is real estate, by making that building more sustainable in a very, I guess, particular way, and meaning having to look into a building, knowing that each building is different, meaning you cannot have a one path approach to a large portfolio. So by gathering all of this data, by deriving certain rules, and by proposing concrete measures that are on the efficiency side, that are on the mobility side, security, climate comfort, we actually create a holistic ESG environment within that building. And that serves the purpose of making its tenants happy. That serves the purpose of saving a lot of energy and being sort of, I guess, the starting point of what could become the beginning of a smart grid when it comes to electricity. Because if the buildings are not smart, it's very hard to come up with, I guess, more macro level solutions when it comes to renewable energy supply and all of that stuff. So I hope your question was answered sufficiently. Thank you.
Yeah. Thank you very much. I just have a quick another question. So if I understood correctly, there are no limits in terms of geographical location. For example, it could be the real estate asset which is in China or in US, in London or Luxembourg. And also there are no, let's say, limits in terms of whether it's residential, whether it's commercial building. You can provide solution for both types.
Yeah. That's absolutely correct, Irina. Thank you. Oh, did I interrupt you? Sorry.
No, it's fine. Yeah, go ahead.
Yeah. So absolutely correct what you're just mentioning. We can gather any building in the world within our platform. Where we are at the beginning is finding those service providers and local service providers, because our software is not only a data collection and of course a reporting tool where we are calculating real-time CREM pathways, for example, for each building, then give concrete proposals to mitigate those pathways and report on those pathways, but also we connect to each of these optimization proposals a list of service providers who can actually go in and optimize those assets on site. And of course, when we talk about markets like China, talk about markets like the US, it's a totally different structure and scheme around the whole service provider idea. So currently we're starting out in Europe, and we are able to provide measures within Europe, also of course within Switzerland and the UK, but we're branching out into other continents as well.
Okay, that sounds actually very, very interesting. When I see that kind of like initiatives and solutions, it seems that it's not that complicated actually to reach our goal. Of course, there are some challenges, but there are also solutions. That's really great. Yeah, I think you use this also for kind of creating such kind of platform and yeah, helping to improve the real estate industry and to become more ESG compliant and sustainable. Aurelian, as a fund manager dealing with various types of assets, I assume you have also some sort of perhaps decision-making process in terms of identification of sustainability risk, consideration of those risks on value of portfolios, and etc. Could you perhaps please share with us how the decision-making process works at Cube from ESG perspective? And how do you identify ESG and non-ESG related assets? What kind of due diligence you perform on various assets?
Okay, so basically, we try. Well, we are an infrastructure player, so we are on a certain number of sectors that we know extremely well. Could be the energy transition, public transport, or telecommunication, a bit of social infrastructure. So it's sectors that we know inside out, also from an operational level. Here, what we're trying to achieve is to take control of companies and grow them over the long term. If you want to do that, you need to position on sector or subsectors or companies that have some degree of alignment with the challenges on the social side or the environmental side. It's not a question about creating an impact. It's just, the way to execute the strategy. And when you have a 10-year horizon, you have to factor in all those risks, etc. So at the very beginning, when we consider investment, at the stage of what we would call a go-no-go one, we would obviously look at the sector, the positioning, to see if there is a red flag, if there is an issue that we don't feel can be remediated. I give you an example. If you take, for instance, a company that is engaged in power and heat generation, it might have some coal assets, but that might not preclude us from entering into it if we can see a clear path and a clear plan to take those coal assets and convert them to biomass or other greener sources. Same with public transport. Today you have diesel buses, but we are moving that to biodiesel and now more and more electric and hydrogen. But we need to see that path. Once we have that vision, we need to confirm it during the due diligence, and we have a specific ESG due diligence where we also address some other areas, notably health and safety. For us in infrastructure, it's important. Human resources, business ethics, and more generally governance, that Flavia mentioned. That's also quite critical. And from that due diligence, completed by potentially technical due diligence, the legal due diligence, and our own analysis, notably when it comes to climate mitigation or climate adaptation, we decide if we do the investment or not. And if we do the investments, what will be our, well, it's not really a 100-day action plan, it's going to be longer, but our 2-3-year action plan to take this company on, the right track, at least on material subjects. And sometimes those action plans are just about, a bit of formalization, a bit of progress in some areas. Sometimes they can modify more heavily what the company is going to do. And the goal is that those action plans will be monitored throughout the holding period, so during 10 years, both by us, so the team, or at least myself with the ESG hat, but also by my colleagues that would sit at the board of directors of the company. And normally we have the majority of the board seats. So they are well placed to push the company in good intelligence with the management to implement efficiently this action plan. That also supposes that on our side, all my colleagues in the investment team are trained and have realized, the importance of the different topics that are present in the ESG action plan. Because if they perceive that, and if the management perceive that as a tick the box and don't really understand why we are asking or why we're trying to do that, that ultimately won't work, especially for the large changes. So I would say that's the core topic. The difficulty always is obviously being able for the investment team to get enough time to take care of those subjects, because that's quasi a new challenge to go that deep into the operation of a company for an investment team, and not be tempted, to say, okay, but all this part is reporting or is marketing or is compliance, etc. So it could be done by other functions that would be, by definition, less close to the assets, so less efficient, and it could create a disconnect between what needs to be done on the ESG and what is actually done in practice. And that I would say is especially the challenge today, as we have more and more new frameworks, new points of reference that can apply. You say, for instance, the taxonomy. Taxonomy is a beautiful instrument, but also it's a very complex one. So as we are organized by sector, I think it will be feasible so that all my colleagues in each subsector are familiar with what's expected in energy or public transport or telecom. Telecom, it's by definition easier. I think they can be trained on those, but I'm thinking it might be a much bigger challenge if you're on a generalist private equity fund, where by definition you can intervene in companies that can be anywhere in the taxonomy scope, noting that the taxonomy is still being developed and there are big pieces that are coming in the next 2 years, I would say.
Thank you. That's very insightful. And so thank you very much for sharing. So if I understood correctly, it's really important, say, to put in place also specific policies, process, and to properly, say, to do due diligence from the initial steps, and also they're coming back to what Flavia also mentioned. So it's important also, let's say, to have an appropriate board composition and who will be able, let's say, engage, and who will be able, who is aware of the different issues and have expertise and knowledge in order to deal with specific types of assets and ESG related matters. So engagement and organization is a key element for the fund manager, if I understood correctly. Yeah.
Exactly.
And we are talking also a lot about data. ESG data, lack of this data, and Flavia, what do you think? What are your views on the relative lack of ESG data and transparency in private as opposed to public markets? How should we handle and cope with this situation? Because obviously there is much more data in public markets than in private, but somehow we still need to find a solution and to deal with this. What are
that's I think a question that everybody would like an answer to. Unfortunately, we can only give an assessment of the situation, keeping in mind that things are evolving. Hopefully the European Commission is going to work towards the development of a solution in terms of supporting with the data challenge that investors and issuers are also facing in the public and private market as well. And of course we've been confronted mostly with the different challenges faced by everybody dealing with ESG data in the public market, notably because of the different kind of methodology of rating that different kind of ESG providers make available, and then also the different kind of scoring that it entails for different companies. It doesn't really give one cohesive view to investors who are interested in finding out in a quick way sometimes, most times rather, how to give a value to the different underlyings in their portfolio, especially when it comes to intangible values such as ESG. And on top of that, of course, there are a number of challenges in terms of defining the different demands from different players, which are confronting not only the public investors, but also LPs that are, trying to become more and more savvy about ESG, but do not know how to tackle, the issue of data quality and data needs that they have across the company, across, their investments. And indeed, perhaps, there are some people that think that, the private market can be considered as an easier one, in the sense that, it all has to do with engagement. What do I mean when I say that? What I mean is really that, in private investments, of course, potentially, there is the opportunity to actually be engaged directly for GPs with the companies and be able to request ESG data directly from the company, at different levels, and of course with different degrees of success. But there is, in theory, a relation that can be built and that can trigger better quality data, certainly being able to cut the middleman, which is in the public space, of course, the ESG rating agencies that I was alluding to. So that could be conceived by some people, like an advantage in terms of the quality of the data around the ESG that we have in this space. On the other hand, yeah, the devil lies in the detail, and so it all has to do with the kind of relationship that investors can establish with the investee companies, and the level of pressure that they can manage to exert on the different companies in that respect, that will determine the kind of success in gathering the data and the quality of the data itself.
Yeah, fully agree. We're also talking a lot about different challenges coming from the current regulations. And as a fund manager, Aurélien, do you see any specific challenges coming from those regulations, SFDR or taxonomy, apart from data and costs? Perhaps any specific challenges linked to categorization of the products?
On categorization, there's been a few discussions in the market, notably around Article 8, because when you look at people that are positioned today as Article 8, I know people that are positioned Article 6 and do much more. Because Article 8 is there are several ways to enter into Article 8, and the obligations are not that strict. For me, the big difference is when you go for Article 9. Article 9 is a whole different category where you have the taxonomy, etc. Article 8 is a bit less stringent in terms of obligation. When you start moving really to Article 9 and the taxonomy, then you have we cannot obviously the taxonomy can be a bit criticized on some aspects, and it's still being developed. There are important pieces that are going to come soon, but it's a very complete referential. It's a very complete way to look at things, also from a technical and scientific point of view. There, if you decide to go and to put yourself into the shoes of someone that claims it has an impact, you have to follow the taxonomy. And that's a big effort. It's a big step, but for that you need to make sure that your strategy will fit into the taxonomy. So for the moment, for instance, we have only the climate mitigation and climate adaptation, where you have the appendix that are well described. So there you can assess if your strategy or the project that you're pursuing can enter properly in the taxonomy, or if not, if you're willing to modify your strategy to, let's say, to fit the requirements. It's not necessarily that easy. I was looking in projects that on paper, you would say, oh, it's a electricity storage project, or it's a green hydrogen production or extraction, or white hydrogen extraction project. It looks like, okay, it should be easy to be in the taxonomy, but taxonomy is complex. You have the technical screening criteria, but you also all the do no significant harm criteria. So if that's one of the difficulties, to make sure that you are able to back your claims and back your choices, not jump, and saying, oh, I'm Article 8, Article 9, and that's because that's what my investors want, and I figure out to do some reporting that will be fine later. That's kind of counterproductive and against the spirit of this regulation that is made to avoid any sort of greenwashing.
Yeah.
So that's one of the things that we need to address is make sure that all strategy are well positioned, aligned, and be a bit modest about what we can do and how we can do it.
Exactly. Yeah, it's important after to put in place all the reports on the information, and also once level 2 of the SFDR will be applicable, it will be also necessary to comply with the mandatory templates. And so it's important to take decision already now, and as regards Article 8 or 9, and try to to find all this required information.
But it's
So
a
if I
very
understood correctly,
it's
you
a very
have
good guide.
Yeah.
In any case, even if you decide to be for a fund manager, even if you decide, okay, I don't want to take risk, I'm going to say I'm Article 6 and I don't report on PASI, it doesn't mean that you should not try to work your way up if you can by developing the methods, etc. That's the direction of the market in any case.
Exactly. Yeah, fully agree. Yeah, better to take more cautious approach and start with 6 and after slowly upgrade to 8 or even 9, of course, if possible. Yeah.
That would be very, very good if that would happen this way. Very, very idealistic, Aurelia.
No, I'm well aware that's not what we necessarily see in the market, but yeah, that's probably how it should be.
Yeah, indeed.
We should start from somewhere. Yeah.
Absolutely.
And Justus, just a quick question to yourself. How can quantify make perhaps life of fund managers easier and make help them to achieve, let's say, the ESG targets, just like any quick and cost-friendly solution? I mean, in addition to what you already mentioned.
I would say that we are the quick and cost-friendly solution. So we know that there are endless possibilities to making real assets more sustainable. And we know that the expertise already exists in the market. If we were to start, we could have every existing building climate friendly and climate neutral within 5 to 10 years. This is not happening at the moment. So not knowing where to start is an imminent problem. What we do is to tackle this impediment is we provide a guided path towards 2050 or 2040, maybe, for each asset automatically. We cut larger asset journeys into smaller, more manageable chunks of tasks, for example, sort of being provided with tenant utility data, making buildings more transparent. We increase the speed and quality of building data collection through gamified digital task management. We make use of any data entry holistically, meaning people don't have to enter the same info twice. And we relieve managers of the reporting burden through automated coverage and sanity checks, as well as one-click reporting construction. 2 more impediments. We know that success of ESG measures often become visible only after some time has passed. And this is a problem because we are sort of falling towards our biases here, which is in that respect the hyperbolic discounting bias. How we tackle that is we can show ESG KPIs in real time. We can create stimulating pseudo gratifications, as we call them, and we propose concrete measures and implementation scenarios for each buildings triggered by the individual building attributes. For example, we can give an ROI of an LED conversion financially, as well as on its CREM and E-Core scores. We integrate the expertise of ESG service providers and generalizable ESG measures that are triggered based on each building's attributes and utilities. And we make tendering and commissioning as easy as never before. Finally, cost of ESG measures are often still more visible than their returns. And usually critics are basing the evaluation of these measures on self-defined criteria that tend to confirm their existing attitudes. On the other hand, with ESG fans, I would call them, it's the exact same way. So how can we mitigate this, I guess, self-confirmation bias? Within our platform, we show intelligent predictions of future returns. We give presentations of the ecological as well as economic returns and social returns. And we provide evidence through our intelligent data analysis. So I would say tech is definitely something that can help mitigate this problem, and it will become more imminent, especially when it comes to sort of onboard existing products to an Article 8 or an Article 9 compliance, and where we have to start is the asset. If those assets are not becoming more sustainable, it's not enough to defund, we have to improve.
Yeah, thank you very much. So yeah, we can say that it's clear that ESG and sustainable finance is going to stay, and it's not just it's a long-term journey with significant opportunities for the fund industry and also for the private sector. And it's clear that it's not just a short trend that is going to disappear in 1 month's time or 1 year time. So mitigating the current challenges should therefore be the strategy of the managers, and everyone should be getting familiar with the new rules, taking steps to implement this, and to do this ideally as soon as possible. So since we are almost out of time, just in 30 seconds, what is the main message that you would like the audience to take away? Or what would be the final piece of advice that you would like to give to the audience? Who wants to start? Flavia? Or?
Sure. I think that, whatever matters most in ESG is indeed to have, a consistent approach that is as material as possible to the business case of the company and that reflects the investors' needs. If you can achieve all of that, I think that you nailed it.
Yeah, agree. Great. Thank you. Justus, Aurelian, would you like to add something?
Yeah, and I would say that the most important issue about ESG is starting today rather than tomorrow, not waiting for the perfect data set to come in out of nowhere, and being able to live with the inherent, I guess, elephant in the room is that regulation is following implementation, not the other way around. So if we start today, we are blessed with decarbonization pathways that are not going to be as strict in 10 years than the other way around. So I would urge my colleagues in the industry to start implementing ESG.
Thank you.
I'm going to repeat basically what has been said is start yesterday and take a pragmatic and operational approach.
Agreed. Thank you very much to all of you. I think it was very insightful, and thank you for sharing your experience, expertise. And so let's perhaps check if we have some questions from the audience. I'll just quickly check the chat and Q&A session.
Irina, if I may add a question in the meantime, there was one thing, actually, it's probably a question to you, Flavia, because Flavia, we were talking about expertise being needed and thought across different asset classes, different kind of investment topics. And what's your view actually on the availability of talent and competence, especially also when thinking about, you talked about a few times, the board. So the boardroom is actually very important. Tone needs to come from the top. So what's your view on, in terms of availability of skilled people and competence to actually fill these positions in order to also put the pressure where needed?
Well, that's something, of course, that it's our key priority at TMF. We are increasingly involved, in this kind of role. So we are asked by our clients to be independent board members. And indeed, our role is to be, to help them actually initiate, the discussion around ESG and to train them at the same time in order to raise awareness, make them understand that, ESG is not a risk, but it's an opportunity. And also a value creator going forward. So basically, it's a very complex journey that we are faced with, and that we live together with the board members, with the other board members. And our challenge is to be able to, play on the right chords that will make them understand what's in it for them and how, ESG can manage to increase the value of the company itself in the face of the investors and other stakeholders going forward, and doing that in a relatively easy way, starting from the basics and, encouraging them to actually put forward key issues that can lead to interesting discussions, hopefully at board level around ESG that can, hopefully help board members become more savvy about the topic and also streamline their level of accountabilities in that respect. So it's a big change, I think, because so far I think that, boards have focused mainly with the governance side of things without really looking into the other aspects of the intangible risks that are part of their missions more and more. And indeed, I think that you cannot talk about sustainable finance without tackling governance, and inevitably governance becomes the most important aspect of the ESG acronym. And so, I think that starting from the board and managing to train the board and make the board understand the value of ESG is absolutely key going forward.
Thank you.
And I think people also at the board that have this, because when you say ESG is very wide. You cannot be an expert in ESG or a specialist in ESG because simply there are 3 dimensions, each one being itself very complex. So you need to find at the board or within a firm, a guy with a specific knowledge on one of those dimensions to really help the company. If one of the major aspects will be climate change, you will need someone that has an environmental science or climate science background. If the major challenge is on the health and safety, because you have a large workforce that is prone to work accidents, you would take someone that has further expertise in that field as well.
Very much agree to what you both were saying. I think also personally that there is not only this demand for specialization on the topics itself, but it's also about what is the future strategic direction of companies. I guess personally also again that firms will specialize because Aurelio, you're spot on. You can't do everything in ESG, and that goes also for investment firms and investment boutiques. So you will probably find to see firms specializing in 1, 2, 3, 4 areas. Maybe the very, very large asset managers of this globe, they probably will tend to go into all directions, fair enough, but the rest, there will probably be a deeper understanding, a deeper competence on specific areas. So thank you very much for that. Irene, I don't know, do you have further questions that you gathered?
So I would say from my side, it's fine. The answers were quite insightful for myself, and I presume also for the audience. What I would just would like to add from myself at the end, it's just like green economy, good governance, and sustainable development should be definitely our strategy for the future. Let's try to do our best and help our environment. And yeah.
Thank you very much. Thank you, Irina. Thank you very much also to all your speakers. I think that was an excellent session, and also thanks to you at GSK Stockmann for hosting the session. Also would like to expand my thank you to the team here at LuxFLAG for having made all this possible. And finally, I'd like to end the session with a quote that I hope will actually resonate with all of you, and that's what Sachin actually said. We now understand that sustainable finance is not just another type of investment, it's actually a complete shift of mindset. So thank you very much again. And for those of you in the audience, our next session will actually start at the hour at 1500 and is hosted by State Street Bank International, focusing on how ESG integration is consistent with financial market theory and the experience of alpha generation in portfolio management practice. So pretty much looking forward to that and hope you too. So see you soon again, and thanks again. All the best. Bye-bye.
Thank you. Bye-bye.
Thank you.